Let's go ahead and move forward with the panel for today. Just delighted that we were able to work with Josh Landau and Colleen McKenna at the IIS and have conversations about putting on a joint panel. It really reflects the strategic partnership with the institutes, and this is really the first, one of the major byproducts of that initial effort. And we thank Josh, Colleen, and the panel for being with us today. This is a great topic. You look at this for us, and I think about environmental, social, and governance. It spans our space from enterprise risk management to ensure investment decisions, ensure underwriting decisions, broader development and protection for the public policy, governmental and industry partnerships that Rowan and Joan have both been very active in, and it just gives us a wide range of areas that we are currently engaged in and can be engaged in. So the timing of this topic is just spot on. So Josh, thank you for helping to make this happen. We very much appreciate it. Let me go ahead and turn it over to you to introduce your panel.
Terrific. Okay, thank you, Randy. Good morning, and as Randy indicated, thanks for joining us for this important panel session on ESG. 2020 was a year of retrospect across social, political, and economic spectrums globally, and inspiring a re-examination of priorities. Beyond the social responsibility, insurers are acknowledging the value of stakeholder capitalism through ESG strategies that deliver shared value creation for customers, employees, shareholders, and society. So I'm pleased to moderate a panel of experts who will explore how insurers are actualizing ESG by embedding these principles into core strategy across the value chain, and how these strategies are resonating in the boardroom, and assess the impact of insurers serving as a conduit for building sustainable markets with a better impact for society. Randy indicated, my name is Josh Landau. I'm the president of the International Insurance Society, the largest and most diverse organization of the global insurance industry. Our members comprise all industry stakeholders, including insurance company executives, scholars, regulators, and advisors from nearly 100 countries who share their diverse knowledge and perspectives to study the forces driving growth and innovation in the industry. Joining me this morning is Joan Lamb-Tennant, former CEO of Blue Marble; Rowan Douglas, the head of climate and resilience at Willis Towers Watson, and he's also the operating committee chair at the Insurance Development Forum; and John Scott, the head of sustainability risk at Zurich Insurance Group. Welcome, everyone. Before we get started, just want to inform the audience that there will be a Q&A at the end of this session. And please feel free to put your questions into the chat, and you can submit them whenever you think of them. You don't have to wait until the end. So let's get started. I'm going to start first by giving a brief bio of each of our distinguished guests, and then we can get into a discussion. So first, pleased again to introduce Joan Lamb-Tennant. Joan is a corporate director currently serving on the boards of Equitable Holdings, Inc., Element Financial Management Corporation, Ambac Financial Group, Hamilton Insurance Group, and the Institutes. Joan is an entrepreneur with global financial and enterprise-wide risk acumen who is known for harnessing private market mechanisms and technology innovations to deliver commercially viable, socially impactful business opportunities. In addition to her work as an independent director, Joan is a senior advisor to Helios Investment Partners, a UK emerging market-focused private equity firm providing financial and risk capital to value-creating and socially responsible businesses throughout Africa. She's also a senior advisor to Brewer Lane Ventures, an early-stage venture firm, and American Family Adjacencies Holdings, a venture firm that builds, buys, and incubates fintechs and insurtechs. Joan is the executive expert on resilience and sustainability for the IIS, and an author and commentator on environmental, social, and governance matters. Joan is also was the CEO and founder of Blue Marble Micro Limited, which was a startup owned by 8 multinational insurance entities with a mission of extending socially impactful commercially viable insurance protection to the underserved. Joan previously was the global chief economist and risk strategist at Guy Carpenter, the reinsurance and risk management operating company of Marsh McLennan, and president of General Reinsurance Capital Consultants. This is important. Before joining the industry, Joan was a tenured professor of finance at Villanova University, where she led the Thomas Lebrecht Chair in Business and an adjunct professor at the Wharton School of the University of Pennsylvania, where she held the Lawrence and Susan Hertz Chair in International Business. He holds a PhD in Finance and Investments from the University of Texas, Austin, and an MBA in Finance from St. Mary's University in San Antonio, Texas, and a BBA with honors in accounting from St. Mary's University in San Antonio. Welcome, Joan. Next we have, thank you. Next we have Rowan Douglas. Rowan is the head of the Climate and Resilience Hub at Willis Towers Watson, leading global advisory and reinsurance brokering company, and the chair of the Willis Research Network. Previously, he served on the board of the group's reinsurance division, Willis Re, as CEO Global Analytics. The CSP practice helps governments and corporates manage large-scale risks and is a leader in developing sovereign and multi-sovereign catastrophe financing programs. And in 2014 to 2016, he led the creation of the Insurance Development Forum of industry, governments, and international institutions to harness the role of reinsurance and insurance capabilities to meet the sustainable development goals and wider post-2015 agenda that was appointed to lead the implementation group of the IDF in May 2016. He was made CBE in the 2016 UK New Year's Honours List for services to the economy through risk, insurance, and sustainable growth. He was a member of the UK Prime Minister's Council for Science and Technology in 2011 to 2016, the Royal Society's Working Group on Resilience to Climate Risk and Extreme Weather, and serves on the Executive Committee of the IIS, where he received the Kenneth Black Award in 2014. Thank you and welcome, Rowan. And finally, we are pleased to welcome John Scott, the head of sustainability risk for the Zurich Insurance Group. He joined Zurich in 2001, becoming head of risk insight in 2007, and was chief risk officer for Zurich's global corporate and commercial insurance business from 2009 to 2017. Took his current role in 2018 and leads the group's engagement on sustainability risk, both internally and externally, as the way Zurich delivers its purpose and values. For the last 10 years in his role as CRO for the commercial insurance and as head of sustainability risk, John has increasingly focused on global risks, in particular climate change risk. His unique combination of previous roles and experiences in the oil and gas and chemicals industries, together with his involvement in many industry and government organizations, given him a deep understanding of the risks and opportunities that climate change presents to companies, governments, and society at large. John is a member of the Institute of Directors Sustainable Business Advisory Board in the UK and the advisory board to the World Economic Forum Global Risks Report. He has contributed to industry and government policy on climate change and green finance through many organizations, including the Bank of England Climate Financial Risk Forum, the UK government's Green Finance Task Force, the UN EPFI Working Group on TCFD, the CRO Forum, the Geneva Association, the Net Zero Assets Owners Alliance, the European Financial Roundtable, ClimateWise, and the Cambridge Institute of Sustainability Leadership Insurance Advisory Council. This is an amazing panel, and I'm really pleased to have been able to provide all that detail for our audience in the breadth and depth of your experience in this critical and crucial topic. So let's get started on a discussion here. I'm going to start just by opening it up and given all of your experience, and we can start with Joan, given your experience as a CEO focused on increasing connectivity into the industry. What role can the insurance industry specifically play in ESG?
I think the insurance industry has got a significant role that they can play in the sense not only in their own corporate initiatives, but also in the companies by which they insure, reinsure, and do business with. They play a role not only in terms of uncovering innovations and ways, setting standards, and creating nudges for behavior change that's needed in the science and technology that's critical to advance environmental and social good. But they also can become a spokesperson and encourage even beyond the customers they serve. And I think we were just chatting before the event began, and I'd like to pass that over to John, because I think some of the work that Zurich is doing falls clearly in that space.
Thanks, Jared. And yes, I think what you said is absolutely right. I think there's sort of kind of four areas for me that insurers have an influence over society more broadly, as you described. I think one is our investments. We are big investors by and large and asset owners, so we can be very influential in that space, talking to our investee companies. We're also underwriters, and that's also really important in terms of being able to talk to clients in that kind of space to help them think through the risks that we insure and how to manage those risks. And that's kind of like the third pillar, which is really around risk management, which I know I'll pass the baton over to Rowan on this in a moment, but risk management is such an important aspect of managing risk. It's not just about risk transfer through the mechanisms of insurance or other mechanisms, but also holding on to risk and managing it if you can. And the broking industry in particular is very important in terms of helping our customers, our common customers, manage those risks. But the final piece, and you kind of touched on it, is a really important one. A lot of the large insurers, global insurers, are very influential in the countries in which they operate. And we are big influencers and advisors to governments to help them think through these risks, because many of these ESG risks, these environmental, societal, and governance risks, are truly global in nature. So it's not sufficient for an individual company or even an individual sector to solve the risk, but they have to work closely with governments. And I think nowhere is this more clear than in climate, where individual countries have set their nationally determined reduction commitments, which form the basis of the Paris Agreement set at COP21. But countries themselves just can't do it on their own. They need support from the finance sector to help influence capital flows, the right investments and the right kind of changes to create the transition to a low carbon or zero carbon economy. And then finally, it has to be in the real economy. So the people who run businesses that are, especially particularly in the carbon intensive sector, but in all related sectors, need to make some really significant changes. So I think working together with government, with finance, and with the real economy, it's where we make the greatest strides. But let me pass over to Rowan on the risk management piece.
Yeah, thanks so much, John and Joan for setting it off so well, and Josh. And just to acknowledge, I haven't been able to join the ARIA program for the last couple of days, but it's the most incredibly rich community that's comes together, and I'm certainly going to make sure I try and attend next year. And looking at the program, so many of the themes are so relevant to this discussion, and I am going to pick up on John's theme around risk. We often have a conversation about risk and opportunity, which are obviously two sides of the same coin. But I think often we're trapped by language. So as folks from the insurance domain, broadly defined, sometimes new language comes up and we almost consider it to be a foreign language which you don't understand. So for many of us, the theme of ESG can seem a bit confusing. Even climate can sort of come with a variety of baggage. Things like the Sustainable Development Goals. What's all that about? Well, actually, ultimately, all these things are about, in my own opinion, risk. So ESG is around how does society, and ESG tends to particularly focus on corporate and private sector institutions. How will a set of environmental, social, and governance risks coming from a slightly new direction, how do they need to be managed to help society and obviously the planet navigate a sensible journey under a whole load of pressures? And it's the same with climate. So and it's the same with the 16 Sustainable Development Goals, which are all basically a set of risks, the sort of risks that insurers deal with, actually. Risks obviously from the environment, from society, from social pressures, from law. And so I have sensed at long last the penny is dropping in two areas. One, finally, the insurance community is beginning to realize that actually this is not some sort of regulatory headache that is around the corner for them to deal with. This is not another piece of corporate hygiene to try and settle. There are some bits of that, but basically what this is about is society and the economy recognizing that we have some massive structural risks in society that need to be understood and shared and managed. And it's really exciting for, I'm sure, all of us on the panel, but particularly me personally, to talk to primarily an academic audience, because this isn't an issue about how to deal with this in the corporate space. It's much bigger than that. It's around a set of ideas. Ultimately, insurance is a system of governance. It's about how do communities at local to global scales decide what is valuable and important to them. What do they want to protect? What rules do they want to put in place to manage that risk or what they want to protect, and share that risk within tolerable parameters? And it is the most incredible cultural asset that has been the product of both a philosophical, scientific, and social revolution over the last 300 years that we all take for granted. And we take it for granted because we're in the industry, and the rest of the world takes it for granted because, quotes, it's just insurance. It isn't just insurance. It is the most incredible essence of a civilized society. And what's really exciting is I'm beginning to read quotes from economists, from novelists and others who are beginning to rediscover the essence of insurance. So where I'm going to go is to say, whether you call it climate, whether you call it sustainability, whether you call it green, or whether you call it ESG, it is actually about insurance in the broadest sense. From welfare, from social insurance, from private sector insurance, mutual and cooperative. It's about how we create proper risk pools that govern behavior. And what we lack are two things. We lack the intellectual thought leadership from the sort of community that is here to inform our industry to think about ourselves in a new way, because we've lost our confidence, we've lost our mojo. But we also need to get these ideas out of our relatively small community into a much larger universe, because the wider world senses that there's something in our community that is of incredible value, whether it's actuarial science, whether it's understanding of welfare economics, all the things that we have achieved as an industry to manage society's massive risks, long-term risks, short-term risks, extremes, behaviors, natural disasters, and brought it into a common framework that marries capital with governance and behavior. So let us use this incredible surfboard to do our duty, to play our part in navigating what is actually a massive climate and wider emergency, which if we don't get right, we are going to have a hell of a century ahead. So when we all read in the newspapers and we think they have got to do something about it, I'm afraid they are we. And we, luckily enough, have the crucible of expertise. We now have to just get out there, use this ESG thing as our ramp, and massively expand risk sharing and risk management and make all of capital as sensitive to risk as insurance capital is. Back to you, Josh, in the studio.
Yeah, that was well said. But just on your last point about the increased awareness, and as an example by this panel and many others that continue to highlight ESG. Why now? Is there been anything that has changed to materially shift the focus towards ESG in the broader context? This team obviously has been focused on it for a very long time. You made the comment earlier when we were getting together that everything that you were saying 5, 6 years ago has actually come true. Was there an event, was there a catalyst that in any of your minds that is causing this material shift towards focusing on this topic in the broader community? Joan or Scott or John?
Well, I actually think it's been bubbling up for some time, to tell you. And of course, we can always look to the most recent events of the last 18 months have been a catalyst, both the pandemic and social reckoning that's occurred in the most recent 18 months. But I actually saw it coming as generational changes occurred. And I actually saw it in the classroom, as I started having been in the academic world and teaching for over 30, 35 years. I saw it coming as a generational push, and so I tend not to relate it to just the most recent events. But I would like to just comment that, who knows, there may be some other letters behind the E and the S and the G someday, because what I really see it as is that instead of just it's behavioral, that we will solve small, short-term problems that we think we can get immediate results on. And we see this behavioral implication all over. I mean, it's part of the reason why we might insure our iPod and not save for retirement, because that's so big. We can't get our arms around it. So we just look the other way. And I think what this really is a shift towards saying, wait a minute, there are big systemic problems out there. And maybe we should use capitalism, not just governments, but use capitalism to look at some of these large systemic problems that has long-term consequences that are severe. And so I look at this as not just E&S, but as a recognition of the role we play in long-term serious problems.
Well, then on that point, who defines what ESG is? And then how do you measure it, disclose it, regulate it, and enforce it as needed? If you're going to leave that into to capitalism, is there a responsibility by governments, by a regulator, to set the standards on what is ethical, what industries are excluded or emphasized?
And let me pick up on that one. So just following on from what Joan said, I think I did my MBA many years ago, and for a long time I had a collection of books sitting on my study bookshelf, which are all about shareholder value. I used to have dozens of books and lots of maths to try and explain how you would understand and manage shareholder value. I think what people have realized over time through the financial crisis of 2008, and then more recently, I think with the Paris Agreement on climate change in 2015, and then with the pandemic over the last 18 months, is that shareholder value isn't, it's not sufficient just to have one metric or one stakeholder. And I think what people have realized now is that there are many stakeholders, not just your shareholders, but other investors, or regulators if you're in a regulated industry, your customers for sure, your employees, and the societies we live and work in, especially if you're a large organization that's global in extent. So you have to think about those other stakeholders too. And then if you then sit back and think about, well, okay, why do we exist as a business? If it's not just to create money for these shareholders, what is it that actually we're trying to achieve? What's our purpose? And purpose can be a horribly, not a dead end, but it can be a rabbit hole which you can dive down into and never get out of if you're not careful. But purpose definitely overarches strategy, it overarches brand. And I think when you think about purpose, certainly that's my experience in Zurich, is that don't give it to the marketing department or the communications people. Good that they are at creating slogans or think about these things in those contexts. Actually go and talk to the people who might have been around when the business was founded. In our case, that's quite difficult. We're a 150-year-old business. But interestingly, you can go back 150 years, and we've got some great posters, actually, which are adverts from the 1870s, one of which really sticks in my mind. It's a picture of somebody lying injured on the ground. It's a man. His family around him crying because he looks like he's dying or he's already dead. In the distance, there's a horse running off, which gives you a clue. This is before the motor car. The chap's had a horse accident, which I guess in the 1870s might have been quite a likely thing to happen. But standing over him is kind of like the angel of death, so it's she has her arms wrapped around him. But standing over the angel of death is the angel of Zurich, holding out an insurance policy, which happens to be a life insurance policy. And it sort of really resonated with me because this is, a 150-year-old advert. Yet clearly this is a time, and I think Rowan touched on this, when before that, if your main breadwinner in your family died, you were destitute. There was no support network. There was no social protection system available to you. And insurance truly was the bulwark against destitution for people in that situation. The same if your house burnt down. And so I think, whether it's so the insurance industry is there to help manage people's risks, help sure they don't get destitute, but it's not just about individuals. It's about these really big issues that we all care about, which are global issues, which neatly fall into this kind of ESG characterization. And it could be climate, it could be diversity and inclusion, it could be a wide range of topics that fall under sustainability. What I think is really important for every company to do and every organization is to do what sustainability people often refer to as a materiality analysis, to sort of talk to your stakeholders, both internal and external, and find out what's important to them. And then when you look at that, the results of that, typically what happens is there will be things which both your external and internal stakeholders and your own capabilities overlap on. And those are the things you should focus on. Because I can tell you there are hundreds of single issue NGOs out there who will come to your door every day asking you to fix some problem. And we just can't, an individual company can't fix all of them. So I think focusing on a few clear key things that you have the capability to change, not only through your organization, but through the stakeholders you touch, then that is where ESG really, the rubber hits the road and you can really make change happen.
Terrific. So it makes a difference socially, but what about from a financial standpoint? How can a strong ESG proposition actually make financial sense? I think you touched on that a little, but Joan, when you were with Blue Marble, obviously you had a consortium of companies, of some of the largest companies in the world. Individually, it probably didn't make sense, but collectively it did. How does an investor look at that if they were looking to invest in a company and evaluate someone's ESG strategy?
Yeah. Just for context, at Blue Marble, we really tried to test and the power of collective efforts and the power of partnerships in solving these long-term systemic problems that threaten not only our business, but our society and our governments at large. We focused on smallholder farmers. So, John, as you've got to narrow and figure where's your strength. And so we took a sector, smallholder farmers, and what we did is, we first invested in some technology, and that was the ability to ingest and structure satellite data alongside a ground truth. And then we designed parametric agriculture insurance solutions for smallholder farmers covering over 20 crops throughout Africa and South America. Now, we needed risk capital. I mean, just because you had a design, you've got to get the risk capital. And, that's where the design of Blue Marble became really interesting because the investors in Blue Marble also committed to providing risk capital for some of our early market pilots. Eventually what we did is design the mechanisms to do kind of end-to-end services, product design, premium collection, claim settlement. And we started bundling these solutions alongside of credit providers, off-takers like Nestle Nespresso, who was buying the coffee beans from the farmers, and also input providers like seed companies. And so we started to really prove this point, and it's to John's point a bit, that you just don't do it alone, you know, but we were the catalyst of getting it started, if you know what I'm saying. And by that, I mean, we did early stage technology innovations and development, early stage product innovation. And then thanks to the owners of Blue Marble, they were willing to say, and we'll back these with risk capital. But they got something really massive started, right? Because they showed the power of connecting seed providers with credit providers, with buyers, off-takers like Nestle Nespresso. We ended up with partnerships not only amongst ourselves, but partnerships with the World Food Programs and large corporates. And that's very, very powerful, you know, just really powerful. So how do you replicate that now and take another vertical? You know, like but what we did, I'd like to say, made an impact in the agriculture sector and certainly on the lives and livelihood of smallholder farmers who were underserved and disenfranchised. But how do we learn from that now and just broaden it into other sectors of our economy?
That's wonderful. Now, we've just been talking about ESG from a risk standpoint and the tools that we've had at our disposal to have that influence. What about the sizable influence that the insurance industry has driven by its massive investment portfolios, and what unique responsibilities and relevance would they have?
Well,
pick up on that one, Joan. So yeah, that's a really good point. I made the point earlier that a lot of insurance companies are large asset owners. And when you're a large asset owner, you have the ability to influence through your actions as a shareholder or as an investor, especially with corporates, whether through corporate bonds or equities. You can influence corporate behavior. You can vote at AGMs, you can raise resolutions, you can vote for or against officers of the company, and therefore influence in some way its strategy and direction. I think, you know, if you think about ESG broadly, and I'm going to flip back a little bit to your previous question, which was how can you sort of make a return? What's the benefit financially of ESG? ESG investing has been around for at least 20 years. And for the vast bulk of that time, actually was kind of seen by the investment industry as a kind of niche area. That it was for people who wanted to feel good about what they were investing in, but actually you took a little bit of a hit perhaps on the return, and you know, so it was niche. So you didn't see any of the big mutuals sort of investing in that kind of thing. In the last 5 years, that's totally different. I mean, it's flipped almost 180 degrees. I mean, it's hard to find a fund which isn't in some way ESG. I mean, pretty much anyone who's invested in a large EV vehicle manufacturer that's based in the US, which you know which company I mean, because most people are invested in it, most ESG funds holds that stock. So you know, it's quite clear that post-pandemic sort of that kind of technology company has, you know, as part of the US equity bubble, you know, that has been a real boost for those funds. So it's far from ESG funds being, you know, underperforming. In fact, actually they're equally as well performing or even better performing than a broad-based fund, but not based on ESG. So I think, you know, things have matured in ESG thinking significantly over the last 5 years.
Have you seen the same thing, Rowan?
Absolutely, and I think what's fascinating is that the spectrum of ESG is so broad, and Joan sort of highlighted one dimension of it, which was around development and social development and the role of companies to be able to promote that for profit, but as well as for good. And sort of at the other end of the spectrum, I just also want to highlight that this is also playing a part increasingly in the very sort of crucible of the kind of core I don't want to say core periphery activities of a company, but just to give you a sense, I'm sure John's and Joan are both involved in this sort of thing, but we are having to work now with boards of insurers and reinsurers here in London, but around the world, where, and this is also played out within the general corporate sector, but I'll focus on insurers because of this session, where their access to investor capital is being driven very significantly by their ESG policy. It's now no longer a glorified CSR. It's not that at all. And it's being driven both by investors deciding where to put their money, because they're getting these pressures from regulators, but also from their investors. So it's coming on the investment side, but it's also, as we all know, beginning to come on the actual underwriting side. And again, this isn't for a whole set of drivers, but it's not just about, if you like, being green for being green. There are some real risk factors. If you're going to, I don't think people generally, I'm going to focus on climate, but I don't think many have really realized what journey we are all about to go onto towards net zero. So we are on a journey in most countries to seek to attain a 50% reduction in carbon emissions by the end of this decade, which will be beyond belief if we get there. But that means reducing the amount of emissions we had in 2020 because of COVID, that proportion, almost every year. And this is going to mean an absolutely structural change to our economy. 20% of US emissions come from agriculture. We all think of electric cars and all these things which are so visible, but actually our whole economy is a carbon economy. It's been configured to support a carbon-based system. We're having to change that, and anyone who's monitoring financial regulation will see that. The financial regulatory system and a pure risk-based system is being seen as the steward of that transition, because it can't be managed by politics to some degree. This is going to be absolutely structural. So what seems like glorified CSR is not. But what's interesting, and John's at the heart of this on the Climate Financial Risks Forum, is, in a sense, this is still all a little bit airy-fairy in terms of what people disclose. It's very discursive. It tends to be at the back of the annual report. No, at the front of the annual report, not at the back. Over the next 4 years, based on insurance-related methods and metrics and models, that we are going to move from a qualitative description of these sorts of risks to a quantitative basis. And people say, well, how do you do that? Well, in the insurance sector, has already done that. It's taken all sorts of vague non-financial risks, from the risks of US lawyers doing incredible things, to the risks of Mother Nature doing incredible things, to the risks of people just smashing stuff up. And we've translated that into a consistent set of data that can inform and govern capital, whether it's looking in the long term, decades ahead in terms of pensions and life insurance or long-term liabilities, to managing the challenge of extremes. I mean, most portfolios are modeled to, in the sort of nat cat space, to understand, distributions of 10,000 years of potential distribution. I mean, far beyond any other financial market, but it's the day job. Yeah. And this incredible set of skills is about to be used so that in 5 years' time, duties of care or regulatory capital requirements are going to be imposed on banks and insurers and investors in these risks which the rest of the financial community is having to struggle with. For us, yes, we've got to learn some new things. We've got to put a forward gear on some stuff. We've got to think a bit more broadly. But basically, marrying actuarial science with human and physical geography and engineering metrics has been applied across our risk spectra and across our asset and liability spectra. Now we need to improve our quality of exposure data to be able to attach our portfolios to a new set of hazards, and we've got to understand the trade-offs and the vulnerability functions and the overall patterns across portfolios. But it's our sector that's going to turn this from airy-fairy stuff to numbers and metrics. And I think within 5 years, as we indicated, it'll be a balance of our expertise as a sector, including our academic partners, public policy and regulation, which is all framed around risk, and capital management, and it's very exciting. And it'll take a while for the standards to evolve. I would say we're sort of at we're just about at breakfast time. So I reckon it's another 5 years, but this is not about CSR. This is really, if anyone who's been through the journey of the last 30 years of the insurance sector and things like, well, our approach to actuarial science and cat modeling in the non-life sector, we live in the modeled world. ESG will be the modeled world and will be hardcore stuff. It won't be fluffy stuff on the side.
Yeah, so Rowan, you mentioned regulatory influence, and I'd like to expand on that for a bit, because a lot of what you were describing was really market-driven, all of these forces coming together to change the value proposition, change the way we look at these risks and have a positive influence. But you also mentioned disclosure and reporting, and there needs to be a consistency, and that's going to all take time. Do we need more regulatory influence to accelerate that process, to make sure that we are having a consistent disclosure or influence on those who are not participating?
Well, I'll kick off, but I know that John and Joan will have a view. So first and foremost, there is an incredible amount of regulatory focus on this over the, actually it began in 2015 in earnest, but it's accelerated. And if you haven't done so yet, go to the Financial Stability Board's website and look at the roadmap. And talking about climate particularly, the roadmap of the Financial Stability Board, and everyone on this call will know that they oversee banks and insurers through the IIS and the securities community, and how that's being orchestrated by a group of central banks and through something called the NGFS. Obviously, a huge new drive coming from the US in that space too. It is absolutely transformational, the push that's coming from financial regulation and its sort of cousins in the credit risk community. And but ultimately, the principle isn't changing. We're not. If you really look carefully, it's not about being some sort of campaign group for green. It's not really about being a campaign group for sustainable. It's about properly encoding a set of material risks into financial judgments to support the delivery of mandates of financial stability at a market level or at an individual prudential level, as well as market conduct. So it's about how traditional mandates around transparency of risk and duties are being not so much reinterpreted, but updated. But I'm just going to finish this interlude with one observation, because again, insurance is exciting, because insurance regulation and the sort of the continuum of insurance from sort of public risk pools and welfare at one end of the spectrum to sort of cat bonds at the other, means that insurance regulation by its nature is having to deal with these risks and challenges in a far more holistic way than I would argue other groups. And I've just seen that on the screen, I've seen Marty Klein Marty Grace on the screen. And this morning, I was reading one of his books. I didn't know he'd be here today because I was writing a little article on the role of insurance regulation for COP26, because we're trying to come up with some ideas about how insurance regulation can be very supportive for the industry in its bigger role. And I'll just read it to you. Page 103, 104 of his in his book, The Future of Insurance Regulation in the United States, but it was back in 2009. How prescient. He said this: far more than in the regulation of other financial service sectors, insurance regulation is the product of normative conceptions of social welfare and economic fairness. Well, if we're not in the midst of a revolution in social welfare and economics with a good wrapping of environment and climate, I don't know. So prescient, Marty, and I'm looking forward to the next edition of the book.
Excellent. Joan, what do you think? Talk to us about your view on the regulatory influence and framework.
Yeah, I'm actually encouraged by, what Rowan has referencing. We do need a reliable, transparent, credible standard by which we can really measure progress, and only then can the capital markets really begin to reflect the good work we do in managing risk, as well as charge us for when we are degrading the economy and the environment, right? And so I think in time it will definitely show up in our cost of capital and access to capital, but only when we have a ability as a society to really report with credibility and transparency. And so that's where I think the role of the groups that Rowan is talking to in setting standards is really critical. Short of that, is this profitable? Well, we have a lot of experiential evidence. I saw a McKinsey report by saying, yes, they're beginning to get evidence that it's showing up in our cost of capital. I think that, the academics that are on this line will understand this very well. Right now, we probably could get any result that we wanted because the data is so spurious, right? But it's having standards by which we report and credibility in those numbers. Will we be able to really start to price and charge for these risks or reward those who are managing them? We did get profitability in our structure. Again, very experimental, but I wanted to go back to that for just a moment. You had to look at the profitability of kind of like the prisoner's dilemma. You had to think about the greater good in terms of the profitability. The insurance was profitable because we drove network effects. We were able to get data from the off-takers on yield so that we actually had like 30 years of data that we could marry with climate data and therefore properly price the risk transfer. It was profitable for Nestle in this example because they created long-term loyalties with the providers of their coffee beans that allowed them to have more confidence in their supply chain. So we, in essence, de-risked the most vulnerable part of their supply chain, which was the producers of their artisan beans. And it was profitable for the credit lenders because we de-risked the loan. The poor does pay back if they can pay back. And so by de-risking the loans, by providing this protection on their crops, they were able to charge lower interest rates. And so net, it was profitable for each, but collectively the profit for these programs was quite significant because we drove network effects amongst all the players.
Just add to that,
Yep,
it's not often you hear anyone talk about regulation being exciting, Rowan, but thanks for bringing that up. I'm sure there's many regulators and maybe some academics on the call who are excited by that. I just offer a slightly different view on regulation of climate. And the challenge with climate change compared with many other risks is that it's truly long-term. I mean, it's outside the scale. Most of the effects of climate change, whether they're the transition risks that Rowan was referring to earlier, or certainly the physical risks, the changes related to a warming planet, whether that's rising sea levels or changes in frequency or intensity of severe weather patterns. These things are really long-term, like multi-decadal. So it's completely out with the sort of scope of a annual budget or an annual financial plan, which is typically what regulators are regulating when they're looking at macro or macroprudential risks. And even if it's within a 3-year strategy cycle or 5-year strategy cycle, many of the risks will fall way beyond that. In fact, some of the risks might not manifest, the worst risks might not manifest for 10 or 20 or even longer. Now, the insurance industry is no stranger to long-term risks. We hold capital for things like employer's liability, for example, which may play out, or general liability that might play out over those time spans. But the idea of through a solvency or capital process to apply some kind of green capital sort of penalty or brown capital penalty or green capital incentive, or to levy additional solvency on a risk that may or may not happen in 20 years' time, has very sort of negative effects. It essentially would build into insurance pricing today, making insurance more expensive, almost to the point potentially where people would not be able to afford insurance, which would be a very bad thing. Or if it happens unilaterally, an individual company decides to do it without a regulator mandating it, well, it's a death knell in the marketplace because you're suddenly a heck of a lot more expensive than all the other insurers, and our broking colleagues will make darn sure you won't get the business. Or if you do it all together in one jurisdiction, well, it's a global market. People will go into a different jurisdiction. So I think regulators need to think really, really carefully about capital. It's a very, very blunt tool. So is solvency in these long-term risk types. The industry has given a lot of not necessarily pushback, but consulting and advice to the regulators as they've been thinking about this in different jurisdictions. And it's interesting, whilst they're all talking about putting in place some kind of regime requiring insurers to report on climate risks and bankers and asset managers as well and asset owners, the whole investment industry, most of them are shying away because they don't have the methodologies available to apply capital in the short term. And I think that makes a lot of sense. It's much better that we understand these risks and try and do something about it, not necessarily just as the insurers or the finance industry, but with governments and with society at large. I mean, Rowan and Joan have both made these points really well, that this is not us acting on our own, it's working with society to make some difficult choices. And in climate, that might be about how do you finance something like flood? If we're getting continuous sea level rise, and worse storm surges, there will be parts of coastal areas which, quite frankly, will be getting flooded so frequently, insurance won't be the appropriate mechanism to manage that. But if people insist or still want to live in those places, the society in which they operate needs to take a decision how that's going to be financed, if at all. Should it be financed through general taxation? And can in some place there be some kind of public-private partnership to manage that kind of risk? It certainly works in some countries better than others. Almost every country has a slightly different approach to it. I know in the US, the National Flood Insurance Act doesn't work brilliantly well. You might actually say it's underwater because you're not aligning the financial incentives with the planning incentives to stop people building in flood-prone areas because they know the government will just pay out. So I think, be very, really careful about regulation. It's a blunt tool, but what's really good is regulators encouraging the financial sector to understand these risks and work across government and across the real economy to find the solutions to them.
Terrific.
Yeah. I think John raises some great points, and it's interesting how the boundaries are beginning to be pushed, and both analytically, but also in regulatory terms. And it's sort of the ARIA community who's going to have a real important role to play. So, for example, in the UK at the moment, and this is, I think, going to be replicated elsewhere, but for the first time, insurers and banks are now having to give formal consideration to the sustainability of their business. I mean sustainability in hardcore rational terms over the next 30 years through to 2050. Never happened before. And the reason was in 2008, Bank of England wrote a pretty punchy sort of change of policy that basically said climate risks are foreseeable. We either have a +3 or 4 degree world, and that's sort of catastrophic, or we have a disorderly low carbon transition, which is catastrophic economically. And this potential risk is foreseeable and relatively certain. I mean, it's the exact balance of these things is dependent on human behavior, but fundamentally it's the laws of physics that are driving this. And to manage that future risk, action has to be taken today. And that was a massive change. So and that's why you're getting companies having to be required to show that they will be viable and sustainable now decades in advance? Are they putting in place the changes? And this won't just be to the finance sector. This will be ultimately to the whole of corporate Britain and corporate America. And this is the incredible change that is happening. So it's changes of perspective, changes in quantifying new types of risk. This is going to be, and what's also exciting is the whole financial sector is being sort of addressed at the same time. So suddenly you're having banks learning about cat modeling from reinsurers. Everyone's coming together. How on earth do you understand equities when all you have is a share price and not much more information? But then to John's point, actually these challenges are where insurance is the gearbox, insurance broadly defined, but these are social issues. I mean, what do we owe each other? And just to, I'll do one more quote and then I'll quit the quotes, but I'm doing some research this morning, and it's exciting that people from outside of the insurance sector are now talking about insurance. So, some of you will know Minouche Shafiq. She's the head of the London School of Economics, which has had its fair share of major economic thinkers over the years. She's just written a book called What We Owe Each Other, A New Social Contract. And listen to this. It says, and this is not just talking about the UK, it's talking about everywhere, we need a new social contract that is about pooling and sharing more risks with each other to reduce the worries we all face. Too many risks are being borne in the wrong place and could be better managed if allocated effectively. Back to Marty Grace's point, that is a question of politics and policy, and how that's then implemented through the configuration of our markets and our economic system, and that's obviously very great. So, but insurance, in my view, is where it all comes together. So, massive questions philosophically, politically, analytically to address. But this is an emergency. We don't have another 5 years to fiddle around and say it's too difficult. This isn't where we should get involved because it's too risky for us. It's someone else's job. I'm afraid those days are over. Everyone's going to be focused and forced to step up. And it's how we address those pressures that we'll face one way or another. So insurance regulators are driven by what policymakers say. Policymakers, they want to get it off their table. I'm sure insurance regulators are going to have all sorts of new things thrust upon them, probably not enough new resources, but lots of new duties. So get ready.
Actually, that's a great segue into some of the questions that we've been receiving. And again, I encourage everyone to put some questions in the chat. I'll go through some of these questions, some directed to each of you individually, and then we'll have a little time at the end to wrap up and for anyone to provide any final thoughts or any initiatives that they may be working on to share with the group. But Rowan, on your last point, and this is a question from one of our audience members. Say currently there is a debate on the ESG factors. Should it be the E, the S, or the G? Should be the focus of the insurance sector. So of the three, is the insurance sector, should they focus on anyone specifically?
Well, I mean, the great thing about insurance is it requires all these things. So whichever one you focus on, you've naturally got to draw in the others. So if you decide that climate's your thing, or climate and the wider environmental challenge, and one could say that is ultimately the biggest challenge facing society over the next 100 years, you can figure out how to share and manage that. But ultimately, what's going to be required is then governance of societies and companies, whether it's companies through regulation, deciding, to John's point, is it just about pure shareholder value, or is that implied? So governance from a political sense. So you'll have to, people always talk about insurance as just sort of pounds, shillings and pence, but remember there's terms and conditions as well. There's a wording. There's rules to join the club, because if you don't obey those rules, the club isn't viable. But then ultimately, this is about people. This is about how we are, to Minouche Shafiq's point, what do we owe each other? So ultimately, it's bound with politics and social equity and identity and all these other rather, difficult concepts, because it's a set of trade-offs. So whichever way you look at it, you can come at it the just transition. So there's three climate priorities: net zero, how we're going to completely transform the economy in an emergency everywhere in the next 30 years. Never been done before. So there's net zero, resilience. How do we protect people from the inevitable consequences, often when it's not really their fault? And then a just transition. Just transition is, okay, we're going to go down the path of net zero because we have to, but that's going to mean all sorts of regions of the world or industries are going to suffer. So we've got to have a whole revolution in social insurance to cope with that. But we don't have the advantages as we had in the New Deal or Bismarck in the 1870s or Attlee in 1945 to do it after the crisis has happened and fix it, because it'll be too big. So we've got to think about this sort of revolution in how we're going to manage this risk. Otherwise, those people who are bound to suffer because they live in the wrong place or the wrong industry are never going to accept it politically. So we'll never get there. So whichever way you can go from whichever piece of the jigsaw puzzle, but they all become equally important. And insurance, because its very nature, is the gearbox that you have to use of the transmission system. It may be through taxation, it may be through insurance premiums, it may be locally shared, globally shared, but ultimately it's insurance that is the only way of navigating this.
Right. Thank you. So one of our next questions, and it sort of relates to that same theme as well, which is how should we think about measuring performance when incorporating ESG into underwriting? Is it primarily societal, brand protection, or even profitable in the short or long term? John, any thoughts about that in terms of how we should be thinking about measuring ESG performance?
So there's a really good report that the United Nations Environment Programme Finance Initiative put together. It's the Principles of Sustainable Insurance that was produced, I think published about 18 months ago, called Underwriting ESG Risks in Non-Life Insurance Business. So I'd encourage whoever asked the question to go and read the report. I will help you understand that. But let's stick with the example, the case study that Rowan was talking about climate. When you look at ESG risks in underwriting from a climate perspective, let's take transition risk. It's not as straightforward as people might think about the insurable risk. You take employer's liability, for example. How would that link to transition risk? Or how would general liability or property, how would that respond to transition risk, separate from the physical risk related to climate change? And I think the answer lies in a hard-learned lesson in the insurance industry, that when economic downturns happen, surprise, surprise, you get more claims that are fraudulent. And that's because people are desperate for money. And they think, well, okay, it might be okay if my business burns down because then I can claim on that property program. I think with transition risks, it's slightly less sort of Machiavellian. I think what happens is that in the sectors which are changing, and they're pretty much all going to change, especially in the carbon intensive sectors, there'll be winners and losers. And the people who are losing out will be financially stressed. And so they won't be doing things like spending money on health and safety programs. And so guess what? 2 or 3 years later, we'll see an uptick in the slips, trips and falls. Well, it seems quite mundane, but these things will have an impact. And the same will be happening with property or boiler and machinery maintenance, for example. If people don't invest money in maintaining their equipment, it's going to start breaking down. And guess what? It breaks down, there's a fire, there's damage we have to pay out on a claim. So I think the thing about most general insurance is that the impacts will be second or third or even fourth order risks related to the climate transition risk. So I think what underwriters need to do is build into their thinking how to understand that. And that's not straightforward. But of course, it's not even just in general insurance. It could be in life insurance, and it could be for other reasons not to do with climate. So if you think about the changes in the workplace, you think over the last 10 years, the rise of the gig economy, for example, how many workers are not even seen as workers. They're just, you just work for an app, you don't work for an organization. Therefore, you don't get statutory holiday pay, you don't get a pension, you don't get healthcare, you don't get any of the benefits that employees would normally expect to get. And in many countries, the social protection system obviously extends way beyond the company to the government, providing safety nets for all sorts of things, and old age care provision, healthcare provision, and so on. And the life insurance industry in particular has a really, really vital role to play in that. So as those changes happen, our life people, underwriters, need to sort of think through the sort of products. This comes back to sort of Joan's experience within Blue Marble, I think, of being innovative and thinking, where are the sweet spots? Where are the things that people need the help? So, it's a great example of the farmers, the small stockholders needing that kind of help. And maybe, to Rowan's point, it might be, people working in the gig economy, or it might be people working in an industry like coal where, we have to shut down that industry to achieve net zero in many parts of the world, but the workers need something else to do. They either need to be, have retirement funds provided partly by the insurance sector, partly by government. They may need retraining and support to develop new economies and investment in new business models. So I think these are all things that underwriters really need to think about in managing ESG risks.
Perfect. Well, we have time for 2 more questions, and then we'll wrap it up. And I'm grateful for the time that everyone is spending here today. One is directed to Rowan, and the other is directed to Joan. Rowan, you have a question in terms of the industry and UN conversations. Is ESG a conversation on its own, or is it a lever to drive decisions related to sustainability and resilience?
When it comes to the UN world, ESG isn't the lingo. So it's interesting. So when you're talking in the UN sort of international public policy sphere, and even in sort of national governments too, it tends to be around sustainable development. Risk actually is quite open. It doesn't tend to be around ESG. What's interesting is when one's talking in the more mainstream corporate and financial sector, particularly in the investor sector, that's where ESG is becoming, the box. That's the zone, and it's quite interesting because if we at Willis Towers Watson, interesting few weeks here at the moment, but at Willis Towers Watson we have a big human capital practice, and if you like, and it's about 40% of the company. And we have the risk side, sort of Willis Re and the corporate, and a lot of this is around risk. But we find the route to get into the sort of strategic level of companies is actually through the human capital ESG zone. You sort of get in there, and then you come in with risk, because risk is what it's all about. And actually, the reason is, I've had this so many times when we talk to sort of general corporates, not specifically financial players, is that the risk is discussed once or twice a year around the boardroom and is seen as being, frankly, boring but important. ESG is seen as being something very positive, and something that, yes, it's about behaving appropriately, but it's also seen about being progressive in a sense of winning new markets, winning new investor confidence, keeping one's employees happy. So, and we are realizing, and how you frame, ultimately these themes are all the same, but it's how you package them to be able to appeal to different audiences. So ESG, very much the surfboard in the corporate space. I would say in the sort of international public policy space and UN world, probably it's more around things like sustainable development and climate. So, and although this just sounds like semantics and linguistics, it's really important. And one of the challenges we have in our sector is our expertise is so good, but the wider world doesn't understand our language, and they just turn off. One example, when there's a big set of catastrophes, there'll be an announcement that Lloyd's of London or whatever insurer, had X 100 million of losses. We call them losses. The wider world assumes that means we don't know what the hell we're doing. They're not losses, it's our product, they're payouts. No one's gone bust, and we just laughed. I can see everyone laughing. But it really matters. How much time do I have to spend trying to convince people outside of insurance that when they hear announcements like that, it doesn't mean that we don't know what we're doing? That's our job. So I really implore us to think carefully how we update our language to connect in different audiences, but also not to undersell ourselves by our own sort of old habits. We've got to have the bravery to be laughed at by our colleagues and use language that they don't feel comfortable with, but actually is where the world is going.
That's well said. It's well said. Joan, we'll give the last question to you, and then we can start to wrap up. You had, and I'm sure we could talk a lot about this, but you had a question about elaborating on the case study of Blue Marble, and specifically how the parametric insurance works.
Well, parametric cover is one that doesn't indemnify, so you don't go out and identify, Rowan, the loss. Instead, you create a payout that's triggered by a weather event that's defined up front. Now, we define those weather events based on the agronomic needs of the crop. So as a way of doing that, we were relatively confident that there was a loss when we paid out, okay? But we never referred to it as a loss, and we basically afforded all of the frictional costs with claim settlement because it was immediate payout to their accounts, and so we were settling the cash transfer due to the event in very short periods of time, it's like in a week. And this was critical because I will tell you the farms that we were covering, the customers we were serving, it would take me days to get there. I spent a lot of time in the field and in personal risk, right? So, you'd fly to Zimbabwe and into Harare and then travel for 2 hours outside of Harare. So these are not places where you can indemnify or adjudicate claims in the methods that we think of. But it's back to the point, I think, that John mentioned and the importance of product innovation here. This was just one of many innovations. And I do think parametric type covers could apply to other than agriculture risk. And I'm working on that actually today through Helios, as a matter of fact. So thank
Terrific.
you.
Terrific.
Back to you for wrap up.
Yeah, thank you. All right, so we've reached the end of our discussion today. So I'll ask each of you just to take about 1 minute just to wrap up if there's any final words or thoughts or initiatives that you're working on. Joan, why don't we start with you since you were just wrapping up?
Some final thoughts. Well, what can I say? In many ways, I feel like I'm just beginning my journey, okay? And I did mostly last mile work, and nothing is more rewarding than last mile work when you're working in the fields with the underserved that have been disenfranchised by insurance. They're not included in society, but also not insured today. But I will tell you the power of first mile work. So the private equity firms that I'm working with, the VC funds that I'm working with, and the boards that I'm on, the power of first mile work. But academia is really important here, okay? Because it's only through research, either experimental like what I did through Blue Marble, or theoretical or empirical, which is something that this academic community is so well attuned to doing. It informs the first mile work. So I want to just really encourage the experimental, the theoretical, the empirical work that you can bring forth.
Terrific. Thank you, Joan. John?
Yeah, just bearing in mind the majority of people on this call, if you're academics, I think there's going to be an exciting few years ahead to understand not just the consequences of the pandemic, which will keep us engaged for many, many years, I'm sure, trying to understand that and how to prevent the next one, or at least mitigate the consequences of the next pandemic. But I think in ESG, and in particular in climate, there's going to be a really great need for a lot more data and a lot more data analytics and methodologies to understand the risks, going back to Rowan's point. So happy days for academics, and you'll help us in the finance industry and the insurance industry try and address these very difficult sustainability risks.
Perfect. Thank you, John. And Rowan.
Well, picking up on John's point, we desperately need your help. We need brains and fresh thinking. I suppose the incentive is suspend disbelief that this is a really exciting area, but we're still, early breakfast. If you're not into it, you haven't missed out. There are not just publishing niches in this space. There are publishing oceans. But if you want a little forecast, if you look at the medal table, I think there's quite a few folks from China on the. I get the sense, I might be wrong. I get the sense there's quite a few members of the Chinese insurance community in the membership and on the call. So if you look at the Olympic medal table, you'll see that China's up at the top there. And they've been climbing up every Olympics. They did pretty well in London, but I have a feeling they're going to end up on top, aren't they? You might not have predicted that 20 years ago. The Chinese insurance sector's through a revolution, and what struck me literally in the last month is the massive focus on green insurance. You read China's latest 5-year plan and the role of insurance, and comes back to our governance and all the rest of it. I've probably had 5 calls with China in the last month, unsolicited, on what is green insurance, and they're doing it because they know they have to do it. I would not be surprised if when we come to the medal table in green insurance and how this market has been defined, capitalized, managed globally, I would imagine that in 2030, the commanding heights of that particular market may not just be in London and New York and Zurich and Munich and Bermuda and Hong Kong and Singapore. I think they could also be in Hainan and in Beijing and in Shanghai and elsewhere. And I think that the Chinese market sees this as where insurance and economic development come together. And if the insurance sector in China don't, I certainly think other authorities in that country do. So watch that space.
Great. We've reached the end of our panel. Joan, Rowan, John, thank you very much. Thank you to your organizations as well. And on behalf of the International Insurance Society, thank you and have a wonderful day. Randy, back to you.
Thank you, Josh. When I saw this panel come together, I was really excited about this particular day and this particular panel, and it did not disappoint. So thanks to the panel. Thanks, Josh, for putting this together. It's been truly exceptional.